March 2020. The S&P 500 down 30% in 3 weeks. A pandemic, shutdowns, pure terror. And right in the middle of all of it, the single best buying opportunity in a decade. Most people did nothing. Some sold. The ones who bought made fortunes. So here's the question. How do you know if right now, May 2026, is one of those moments again, or the beginning of something worse? The answer is not on CNBC. It is not in a Reddit thread. It is a framework, a way of reading the market without the noise. That is what this video is. The phrase "best stocks to buy right now" gets searched millions of times a month, and almost every answer is garbage, a paid list, a recycled thesis, an algorithm wearing a suit. But the question itself is right. The problem is how people ask it. They want a ticker, a name, something to buy so they feel smart. What they actually need is context, because a great company at the wrong price is a bad investment. A boring company bought at the right moment in the right sector, that can be the trade of the year. So let us talk about conditions, because conditions are everything. Interest rates have started coming down, not fast, but the direction has shifted, and that shift is everything. When rates are high, future profits are worth less today. Growth companies get crushed, cash-burning startups collapse. The math punishes anyone borrowing to build. When rates fall, the opposite happens. Future profits become more valuable. Capital flows back into growth. The tide turns. Right now, the tide is turning, but slowly, and only toward companies that have something real underneath the story. Inflation has cooled, but not vanished. Sitting in cash is still a quiet form of losing money. The labor market is softer but not broken. Earnings are not falling off a cliff. Analysts call this a soft landing. The economy slows but does not crash. Here's the thing about soft landings, though. Everybody declares one. Very few actually happen. Rates falling, inflation cooling, economy slowing. Where does that point? Profitable technology. Not meme stocks, not pitch decks with no revenue. The cash-generating tech companies that got dragged down between 2022 and 2024, not because their businesses broke, but because rising rates mathematically shrank their valuations. Microsoft, Google, select semiconductor names. Their free cash flow kept compounding. Their stock prices fell anyway. That's a dislocation, and dislocations eventually close. Now add AI on top. The infrastructure build-out, chips, data centers, energy systems, that's a multi-decade spending cycle. The companies supplying the picks and shovels are not speculative. They're selling to corporations with unlimited budgets and a strategic terror of falling behind. The California gold rush made a lot of miners poor. It made Levi Strauss very wealthy. Here's where we have to get honest. A lot of the AI trade has already happened. NVIDIA went from roughly 150 in early 2023 to over 800 at its peak. Anyone still calling this early-stage alpha is either uninformed or selling something. The easy money is gone. So where does the next wave land? Not the chip makers, the companies building on top of the infrastructure. Software businesses embedding AI into products people pay for repeatedly on subscription. Companies where AI is not the pitch, it's the moat. A business that uses AI to do what 5 people used to do with 1. Margins expand. The product improves faster than competitors can react. That's not an AI story. That's a structural competitive advantage story, which is what investing has always been about. Here's the boring idea that quietly outperforms in this exact environment. Healthcare. Not biotech. Biotech is a lottery ticket. Stay away unless you enjoy losing money to binary FDA decisions. Established healthcare, medical devices, pharmaceutical distribution, insurance infrastructure. Boring names, consistent cash flows. Dividends, the stocks nobody mentions at a dinner party. When the economy slows, people don't stop needing healthcare. Revenue is structurally protected. And right now, while everyone was chasing AI and semiconductors, healthcare became one of the cheapest value propositions in the entire index. Quiet, unglamorous, potentially very smart. Now, the thing that could make all of this wrong: geopolitics. Markets have spent 3 years choosing not to price in geopolitical risk. The assumption baked into every valuation is that supply chains hold, trade relations stay stable, and the global economic architecture built after World War II remains basically intact. That assumption is under more stress right now than at any point since the Cold War. If it breaks, a major trade relationship fractures, a conflict disrupts global supply chains, the framework becomes complicated very quickly. The market prices risk only after it materializes. By then, it's too late. This is why diversification is not a cliché. It's the only honest response to genuine uncertainty. You don't know what breaks or when, so you hold enough across enough things that the unexpected does not destroy you. The stocks to avoid right now are not bad companies, they're good companies at insane prices. 100, 150, 200 times earnings, real products, real growth. But the math requires everything to go right for a very long time just to justify the current price. This is the trap. Conflating a great company with a great investment. They're not the same thing. WeWork was a fascinating company. It was a catastrophic investment at the price it was offered. The question is never just, is this a good business? The question is this a good business at this price, given what the next 5 years actually look like? Most people skip the second half. That's where the losses come from. Nobody knows what the best stocks to buy right now are, not with certainty, not Jim Cramer, not a hedge fund with 200 analysts. What the best investors do is build a worldview. They decide what they believe about rates, about technology, about risk. Then they build a portfolio that performs well if they're right and doesn't blow up if they're wrong. That's the whole game. And here's what I keep coming back to. March 2020, best buying opportunity in a decade, sitting there on the screen. What made it so hard was not a lack of information. It was that buying felt insane. Everything was falling apart. The question nobody can answer for you is whether right now is one of those moments. Maybe we're in a slow recovery that rewards patience. Maybe we're 3 months from something nobody has priced in yet. The investors who win over the long run are not the ones who always get it right. They're the ones who stay in the game long enough that the wins outweigh everything else. That's not inspiration, that's just the math.